Welcome to this video where we're going to talk briefly about LIFO liquidation and what that means. LIFO, as we talked about before, ends up having kind of a residual inventory over time in the sense that the prices can get very stale. In the Bluth banana stand, LIFO is this one in the middle with Job, where Job is lazy and he grabs bananas from the top of the banana freezer. He never digs down to the bottom to get the bananas on a stick. He always grabs the bananas from the top of the freezer. And because Job has this approach, our accounting of the inventory will be mismatched to the price. Now, remember, for this example that we're using, we're assuming bananas don't go bad. That's not something in reality, but that is a reality when we have inventory, all right? So, and the other thing to note too is that, our inventory management system, how we account for this, doesn't have to match the actual flow of inventory. There's no requirement of that. I'm using this merely for an illustration and example so that you can see what's going on. So when we talk about LIFO liquidation, what we're talking about here is a moment where the company sells through all of its inventory, all the way down to the bottom of the freezer. So imagine us, Job, over time, being lazy and grabbing from the top, but we don't put any more bananas in. We don't put any more bananas in, and he goes through the entire freezer. Guess what? We've eliminated all of those old prices that stayed inside of our books as a result of adding inventory and not selling out all our inventory down to the bottom. When we sell out everything, we sell through all those bananas, that's called a LIFO liquidation. And the interesting event with this is if you have a period of increasing prices, which we seem to always be in, the period of increasing prices causes a LIFO liquidation where your margin actually increases because you have all these old prices of old bananas that are down there. Now, we're saying that they don't go bad, but these old prices and old bananas that go there that are down at the bottom, they get put out and on the income statement, and you'll have a bump in your margin. And it's important to know this because if a firm liquidates through their LIFO, are they really more profitable that period? Or is that just a residual of the accounting phenomenon? Well, it's more of a residual of the accounting phenomenon than anything. All right. They're going to still collect the same amount of dollar bills that they would otherwise. And so this is like an accrual, anomalous effect that happens associated with using just LIFO, just when Job is the one managing our inventory if we have him running the business, over several years. So LIFO Reserve is something that comes in. It's an accounting issue that comes out when we liquidate all our inventory, and then our income statement shows a lot of old prices on it. This happens in businesses, and it's important to just be aware of what a LIFO liquidation is and how it works. You have to sell through all that inventory, and when you do that, you're going to post some most likely higher margins on your income statement because you're going to have older prices going into your income statement. Are there scenarios where it could not be the case? Absolutely. If you have a deflationary time period, you can imagine the prices going down over time, but most of the time prices go up over time. And so the LIFO reserve, when you liquidate that, you're going to have some pretty stale prices in there, and it could have a juice your profits a little bit for accounting, but it doesn't change the cash flow aside from the taxes. So that's LIFO liquidation.